Hey, Metalworking Nation, Mike Payne back here with the next line in our MBA series for machine shops. Um, Last episode, we got a little technical on how to form your company, right? So our very first episode was just kind of that, how to gear yourself up to become a top shop. Then we went into the mentality of an entrepreneur or a founder. And just kind of the grit it takes and all those types of things. Last episode, we talked very specifically about how to just really the very first step of just starting your company. How do you form should you form an LLC or a corporation or a partnership? And, some of the different structures that you can do and why you might choose one over the other. So if you've gotten that far through this, now you're maybe saying, okay, I've got that done. Now I need to start this gig up. And so the next step would be funding it, and that can be maybe the biggest, scariest step. So we brought in another great contributor from CliftonLarsonAllen. We've got Jon Hughes. Jon, welcome to the show.
Thank you, Mike. It's a pleasure to be here.
Why don't you tell the listeners a little bit about just kind of who you are, what you do at CLA, and so forth.
So I'm Jon Hughes. I'm with CLA. I'm a principal and CFO consultant. Mike, I promise I won't call you to the principal's office. So with CLA, I help business owners within the manufacturing industry with accounting and finance, and that comes in a variety of different forms, but it's really about understanding the goals of that owner, helping them to use the accounting and finance function in the business to improve profitability, build that business value, look for ways to reduce risk within the organization, and then ultimately help that owner with their long-term goals and succession planning. So it's truly a pleasure to be here. I've spent most of my career helping owners in the manufacturing industry, and glad to be here with you today, Mike.
Well, Jon, that's a great background. Thank you very much. So when I think about funding a business, I think you can put that in several different buckets, right? And there's a lot of things to consider. So I think as a topic, funding your business is important, but there's really probably a lot of buckets that we could go into from there, because obviously you've got operations you need to fund. In the manufacturing space, you're going to have equipment you need to fund, and then maybe whether you want to buy a building or rent a building, anything like that, there might be another bucket of funding. There's a lot going on there when we talk funding. It's not just a simple topic. In the last episode, we talked a little bit about like buy versus lease on your real estate, and so there's some considerations there. I think we can probably set aside the real estate piece of funding. That could be a whole topic in and of itself.
Sure.
and maybe we can cover that on another episode in the future. But I think as you're looking to start, I think where most people would be concerned is, how do I fund operations and equipment, right? So I'm going to need equipment financing. I'm going to need working capital. I'm going to need to be able to hire people. Maybe some of my tech stack, as far as both hardware, technical, IT hardware, maybe software systems, those types of things. On that front, I would probably encourage people to think about that in their operations funding, because especially in today's world, so much of the software that we're going to be talking about in a few episodes in kind of building your tech stack is, a lot of that's available, as software as a service and so forth. So, it can be kind of more of a monthly expense than a big outlay like it used to be. So from there, if we really drill in now on operations and equipment, that does create two different funding buckets in a lot of cases. Would you agree with that?
I would, Mike, and that's a great point. You look at things like capital equipment that are required to start a shop, and that's in many instances those are going to be your biggest expenses unless you're looking at something like real estate. But then you also have the operating expenses, and I think as you're going down this, starting this journey, and thinking about your dream to become a shop owner, I think the initial question is really around what are you funding? Are you looking to start a brand new business where you're going to be going out looking for a space? Perhaps that's something you're renting. Then you're going out and looking to acquire equipment. That could be new equipment. You could also be looking at used machines as well. It's probably a more likely scenario for many of the listeners that would be looking to start their own shop. And the other bucket there is really those operating expenses that you're going to have. And as you're starting a business, an important consideration is to make sure that you're going into this endeavor with enough what we might call working capital, which would be to cover those operating expenses, to pay the rent, to pay your payroll, to meet those insurance payments and other recurring expenses that you're going to have there in the business. So you might look at it as one route would be we're going to go out and start a shop from scratch, and thinking about the expenses in those two buckets, the capital versus the operating expenses. Or another way to look at this might be are we going to go out and acquire an existing business where we're purchasing a business that not only has the equipment and people, but it has a customer base, and there's some recurring cash flow that that business is going to generate. And this is really an important consideration as you're getting started. And there's risks and opportunities with both scenarios. And it's important as you're going into this to kind of understand your personal situation and really what your goals are and which route makes the most sense for you. And we can certainly talk through some of the differences and what that means in regards to how do you finance this dream business.
Yeah, no, that's an excellent place to start. And I know, I have my opinions, and I've shared them on some other episodes, and I've shared them on social media and so forth. And I'm personally a big fan of buy over build. I think in the current manufacturing market, there's the silver tsunami hitting the entire economy. Um, Manufacturing, I think it's even greater that there's an abundance of 20, 30, 40, 50-year old shops that have retiring owners that maybe they've been on cruise control. Like there's some money that needs to be invested in them to really take them maybe to where you want them. And what I hear from people that are, when I've talked to people about maybe you should buy, like maybe we should buy a shop, find a shop to buy. They're like, yeah, but it's got, everything I've seen has older equipment, and it doesn't have, I want to be this latest greatest 5-axis automated shop, and it's not, right. It's got old machines, old work holding, old tooling. And where I point people in that conversation is, look, I get that, right. I mean, I've bought 5 shops in 7 years, and I get it. Those shops are all that same thing. It's a tired older shop that just needs an
Mm-hmm.
influx of energy and capital, and but it does give me a base to build on. It brings me cash flow. It brings me employees. It brings me some equipment to start generating cash flow that I can then reinvest in the company to get the latest and greatest equipment and work holding and IT systems and all the things that kind of bring you up to a more modern, advanced machining environment. And that's where my personal take is generally going to be, is going to point people to buying a business. I've worked with a number of people over the last several months that are thinking about it all over the country. And they're like, I just don't even know where to find one. And in most instances, within a week, I can find them 3 or 4 shops for sale within 30
Mhm.
minutes of their house. Um, so that opportunity is out there, and I love that you pointed out the financing piece, because it also has an asset base that can be loaned against, right? So it
Mhm.
has some
Absolutely.
equipment. It's got, let's say it's got 8 machines, and the company's been doing $1 million a year or something, or maybe 1.5 million, 2 million. You know, that's something a bank can look at and loan against.
Yeah, and it's a great point, Mike, because it almost seems counterintuitive that as you're starting off here, buying a business, an existing business, actually can be less risky than going out and trying to start something from scratch. And to your point, as we're looking at options here to finance, from a lender's perspective, it's all about risk. And with an existing business, not only do you have assets that you're acquiring that have value and can provide a base for borrowing, there's also a track record there of business performance. There's cash flow. There's going to be receivables as you acquire that business, and there's going to be cash coming in the door as you collect those receivables. And that business history and the ability for a lender to look at that and be able to predict the future cash flows from the business makes it a less risky investment from the bank's perspective. And also, um, in some instances, there are better options for financing when you're looking at acquiring a business versus going out and starting one from scratch.
Yeah, so let's use that as a jump off point to talk about some of the different types of financing, because one of the probably prevalent methods of financing, this type of endeavor in buying a shop at that point could be seller financing, right? So let's start there and talk about what is seller financing, what does that look like, and what are the advantages or disadvantages of doing that. Now, that's obviously going to be if you're buying an existing business. So
Yeah,
let's
Mike,
start with that one.
and I love that we're starting there with seller financing because I think in most instances, this can be the most viable option for somebody that is looking to become a business owner, wants to own a shop, but personally doesn't have the savings or capital that might be required to go out and buy a business and certainly in cash, or to even have a down payment to work with a bank on financing.
Sure.
So when we think about seller financing, it's really, it's identifying an opportunity with a shop owner where you're selling yourself not only in what you're bringing to the business as far as capital and the ability to buy that business, but you're also selling your qualifications and what value you're adding to that business. So we're in a period of time here where there are a lot of shop owners that are getting to the point where they're looking for options to retire.
Sure.
And in many instances, they may not have a buyer lined up for that business. Um, in some instances, there could be some leaders within that organization that have an interest in becoming owners in the future. So, to a business owner that is interested in taking seller financing, they're really taking a risk here that the business is going to be able to continue to generate profits. It's going to continue to generate cash flow and to be able to repay a loan, because in seller financing, the seller is giving ownership of the business in exchange for a loan. So they may not be getting any cash on day one,
Right.
or they may be getting just a percentage of what the business is actually worth. And what they're betting on is that you as the incoming owner of the business are going to be able to continue to run a profitable business that's going to be able to generate the cash flow that's necessary to repay that loan and ultimately provide the value of the business to that owner.
Yeah, and real briefly, let's just touch on. I mean, that might sound too good to be true to some people, right? Like, well, why would someone just sell me their business? They don't give them anything up front, um, and I'm going to pay them out of the cash
Mhm.
flows of their business to buy their business from them. I mean, that's essentially what we're talking about doing, right? So, um, if we break that into from a seller perspective, why would if I'm looking at that as an option, why would I even ask the seller to do that? I mean, the advantage for the seller is one, it may, as you point out, that if they don't have a succession plan in place and they don't have a buyer, it may be their only option, especially if they have not maintained the business grade over the last 5 to 10 years as they've been thinking about selling. Their only other option in a lot of cases might be, well, I'm just going to lock the doors and auction off all the equipment. So at the very least, they're going to get that plus some upside, right? The other thing I see sellers like in that case a lot of times is it creates a 3, 5, 7 year, whatever the terms of that note is, it creates an income stream for them. They're going to get $20,000 a month for the next 5 years, or whatever the terms of that loan might look like. Um,
Uh,
the other thing too, I know when I've done seller finance deals as a buyer, um, it doesn't cost me either way, right? So I will generally offer the sellers like, look, I'm going to go borrow this money from the bank at these terms, or I can give you that 6.5%. So if they're not in desperate need of that cash today, that's an annuity stream for them for the next 5 years or something.
Yeah, absolutely, Mike. And you raised a couple of really good points there. One, I think we have to have realistic expectations as to what we're acquiring. And, we think about the types of businesses where, the owner is going to be willing to take back seller financing or a significant amount of seller financing. Often you're buying a diamond in the rough.
Sure.
This isn't you're not buying a gem, right? There's the
Right.
potential there to turn this into a diamond, but that's going to take that sweat equity, that leadership, and really ability to build that business. um, the other point that you raised that's excellent here is that from the seller's perspective, there can be some value to taking that money over time. And this, we may get into a little bit of consult your tax accountant
Sure. Sure.
territory, but there can also be tax advantages to
100%.
taking those payments in installments over time as opposed to getting a lump sum, payment on the day of closing.
Yeah, for sure. No, there's a lot of advantage to a seller finance structure, and matter of fact, most of the deals I've done, there's been some element of seller finance, even if it wasn't. I guess I haven't done any of the full amount, but maybe up to 50% of it. Um, we're doing as a seller finance deal, and in a lot of cases, it works out really, really well for the seller on a net gain standpoint. Um,
And I think, Mike, you're right. Often this isn't 100% seller financing. There is going to be some element here of it could be that there's some down payment that
right.
the buyer is making that's coming from personal funds, and it could also be that there's a mix here of seller financing, and then there's also a bank loan,
Sure.
and it could be a combination of things that make up the purchase price, and the ability to be creative and put together a couple of financing sources in many instances are going to be what's needed to get that transaction to a close, particularly for somebody who is just starting out here, doesn't have a lot of savings or
Sure.
assets to be able to go out and make a significant down payment.
Yeah, and I think on that topic, I think we did it. We probably we went off onto the seller finance because we were talking about buying an existing business. Let's take a step back. The most obvious and first funding option that people think that they have to have is $1 million sitting in the bank, and most people don't, right?
I don't know
So
anyone.
yeah, so I mean, there's obviously the easiest, cleanest funding option that anybody could look at is I've got the money sitting in the bank and I can just go do this, right? That's funding option number one is you have your own cash, you just do it. Personal savings, whatever it might be. Ignoring that because not most entrepreneurs are not sitting in that boat. You might have you might through yourself and a loan from your parents or something like that, which is very common. Have $100,000 that you can put towards buying $1 million business into, as you said, maybe some mix of all these different funding options. And I think when we get to the end of this, maybe we talk about some structures that we've both seen that have worked well. But yeah, we did kind of skip over the cleanest, easiest option, which is just write a check. I mean,
Yeah,
if you can do that, and you don't need to listen to this episode.
that's right.
Um, but okay, so the seller finance is obviously only going to be in a situation where we're going to be looking to acquire a business. There's a lot of advantages to that. I think that's something everybody should be thinking about if they're looking at starting a shop. In my opinion, that's the first place you should look, and I would be happy to talk with anybody that's thinking about that, about maybe how to take those first steps in even finding a shop to buy and those types of things. And we've done some other episodes we can point you to and so forth. We talk about that quite a bit on like my By the Numbers show. There's been that we've talked about that multiple times. Um, so let's say I'm either starting new or my seller has zero interest in financing. So I've got to go some maybe more traditional routes. And let's talk a little bit about what those options might be and what it would take to get those options and maybe some of the pros and cons of those options.
Yeah, absolutely, Mike. It's important to, as a starting point, to first assess your personal finances, and that's really taking an inventory of both what you could contribute here to a business, whether that's in an instance of potentially finding something that you have enough saved to acquire the business, which is probably a rare occurrence, but looking at what you can contribute towards a down payment. So that's savings that you may have or investments, but really taking an inventory of your what you might call your personal financial statement. The second piece of that is really understanding your financial needs, having a personal budget, understanding as you're getting started here as a shop owner, what are your personal requirements? What do you need to take home every month to be able to meet your expenses, to make your mortgage payment and keep the lights on at home?
Right.
So I think, starting with an assessment of your personal finances would be step one. Now, in addition to funds that you may have personally, certainly, friends and family that are willing to help you in getting started here and pursuing a dream. If you're fortunate enough to be in a situation where you
Sure.
have, folks that are close to you or in your circle there that can help you get started. That could be give you a leg up here. Um, Another option would be to look at if you're a homeowner, and there's certainly risk associated with this, but do you have equity in your
Mm-hmm.
home? Is there ability there to take a home equity line of credit that could be used as a down payment to go out and start or acquire a business.
Yeah, and that, I know that just talking about putting your house on the line scares a lot of people. But I think one thing, as we continue through this discussion of different types of funding options, one thing everybody should consider is whether you do it through a home equity line of credit or not. In most cases, if you're a new entrepreneur buying it, starting a new business, that home's going to be on the line anyway,
Hmm.
right? Because you're going to have a personal guarantee on any of these loans that you're going to do. That if you fail, your house is at risk as well. So, I know when I've talked about home equity lines of credit with people, they're like, "Oh, I can't put my house on the line." Well, you're probably going to anyway, in some form or fashion of your financing.
There's no escaping it. There's significant risk involved here, but right, we're funding our dream. This is
Right.
something that there's a strong why behind it. If we've gotten to this point, we need to be fully committed. And I would say
Sure.
even to the extent of, you might say, we're willing to burn the boats at the beach. Like
Yep.
there's no going back. We're going to do this. We're going to take on that personal risk because, we believe in the vision here. We believe in our ability to run a successful shop, and we're willing to take those personal risks. And that, you're right, Mike, that involves, even if you're not taking that home equity line of credit, your home is likely one of your biggest assets, and that's being signed here as collateral as you're taking on loans and acquiring that business or buying equipment.
Yeah. So with that, so everything we're starting to talk about now is starting to circle around the bank, right? So whether that's a line of credit or a traditional bank loan and so forth. Now we're talking banks. So and again, we've had episodes in the past on making chips and on by the numbers where we've talked with banks and forming relationships with banks, and people could absolutely should go listen to those banking episodes, and to help find a bank. I mean, because that's what bank you end up with can be just as important as the terms of the loan as anything. But let's talk a little bit now about that bank loan. Again, let's assume that we're either starting fresh or there's no seller financing involved. We're going to bank loan this thing, period. Um, so we're going to have a couple of options there. Traditionally, is going to be just a kind of a traditional bank loan, and then maybe an SBA loan, right? Which I think banks are going to push you more to the SBA loan for sure on this. But let's talk a little bit about kind of that traditional banking funding option.
So with traditional bank financing can be a viable option. Um, the caveat being that typically requires a higher down payment than other loans that may be available through the SBA or Small Business Administration, as you alluded to, Mike. So with traditional bank financing, we may be looking at something like 20% down payment. And with traditional bank financing, what's going to be important here is to have a solid business plan. And the bank's going to want to see that because they're going to want to be able to evaluate your ability to repay that loan, which really comes down to that plan and what do we expect the future cash flows are going to be from this business. So for traditional bank financing versus some of the other options, you may have some more flexibility here. You can work with bankers that aren't necessarily SBA banked lenders. You may have a relationship with an existing lender. I think the con to this is going to be likely a higher down payment requirement than an SBA or other financing options.
Yeah. So then, in the SBA realm, let's talk a little bit about that and what. So we've said SBA a half dozen times now. What does SBA stand for?
So SBA is the Small Business Administration, And one of the things, Mike, that is important to point out is the SBA banks, the SBA backs loans that are originated by lenders. The SBA itself is not a bank. So this is a small business administration, and one of their functions is to help small businesses obtain financing by backing those loans that are made by your lenders, or in some cases, non-bank financial institutions.
Yeah, and in my experience, if you go to a bank with what we're talking about, they're going to almost exclusively go down the SBA route. Would you agree with
Absolutely.
that? Yeah,
Absolutely. Yeah. And it's because of that guarantee that the SBA is making in backing those loans with the lender.
right. And
And
and the downside to an SBA loan, in my experience, is it also takes longer.
it
Um,
does. You're
it's
right. So
yeah, your underwriting is just takes a little bit longer.
it does. And there are some specific qualifications that are required, and it's typically a longer uh, loan process to get to funding or get to a close versus what you might see with a traditional bank loan. Um, but those additional requirements help you to qualify for loans that otherwise may not be available to you by going through, a traditional bank loan.
Right. Now, maybe a pitfall that I've seen in SBA loans, addition to the a little bit additional timing and so forth, can also, once you're in operation and you're going, and maybe you want to start paying that loan off or something like that, there's sometimes some caveats to prepayments and so forth, and you can't necessarily transition out of those loans as quickly as maybe you could a traditional term loan. Um, but I don't know, in the realm of the type of funding we're talking about buying a business, I don't know how many, especially if you haven't done this several times, how many people are really going to have the option of a term loan versus an SBA loan. That, in my experience.
Yeah, no, I agree with you, Mike. I think that, right, for many entrepreneurs here, the traditional bank loans are not an option. So they're looking at an SBA backed loan or something like seller
Right.
financing. And the most popular SBA loan program is the 7A loan program, which can be used for business acquisitions. It could also be used for working capital and equipment purchases. Um, those can be up to 10-year repayment terms. So we think about going into business, it's really about understanding that business plan. What do we expect the profit or cash flow is going to be? And then also factoring in here that we're now going to have a loan payment to make
Right.
each month. So
Regardless of how good or bad the business is going.
that's right, Mike. So yeah, if we sell, if we have a record month, we're making the same payment. If we don't sell anything, we're
Right.
making the same payment.
Yep.
So
That doesn't go away.
it doesn't go away. So the ability to, finance that over a longer term can certainly be helpful to make that cash flow work, to get that payment down. Um, you know, typically you can finance up to $5 million with the 7A loan, and the rates tend to be pretty competitive. They are based on prime rate, um, which as of the time that we're recording this is about 7.5%, and you typically
Yeah.
pay prime rate plus up to 2.5%.
Sure.
Um, but with this
But
S,
that'll traditionally be better though than a term loan, right? I mean, you're going to add a couple more point, or maybe a point or so more for a term loan traditionally, right?
yeah, this is certainly competitive with the traditional term loan, and really it's allowing you to qualify for something that you otherwise, may not qualify with for the bank,
Right.
particularly if this is your first time as a business owner.
Okay, so we've talked about, so you can fund it yourself if if you're flush with cash, you can fund it yourself. You could, if you're acquiring a business, you can look at seller financing, and then we can look at the more traditional banking, which I think again most people are going to be driven towards an SBA loan. Now, we talked early on about there's kind of a couple different buckets. There's this operating budget and there's this equipment budget, your funding needs. Um, let's talk a little bit about in the traditional banking world and that SBA loan world, um, what they will and won't finance um, when it comes to equipment versus operations.
So with the SBA loans, you can finance both the equipment or the acquisition of a business, and also look to get additional financing for working capital, which is a very important consideration as we're going into this as a new business owner. We need to make sure that there's enough cash in that business to be able to make our payroll and to cover expenses. Now, we talked a little bit earlier on about, one of the advantages of acquiring an existing business is that, you do have you have customers, you have receivables and cash flow, but as we know, those aren't, there are ebbs and flows in the cash flow. We need to have a buffer there to ensure that we have money to cover expenses in a down month. So when we're looking at financing, it's important that we need to have enough funding to both cover the acquisition of the business as well as the working capital that's going to be needed here to fund our operations as we get going. Without that type of buffer there to provide for working capital, we could be putting ourselves in a really challenging position out of the
Sure.
gate.
Yeah, so let's talk briefly about that. I think most people listening to this, thinking about maybe starting their own shop or buying a shop, they have their ideal list on like the equipment side of things, right? So they know they want a lathe and 2 mills, or whatever that equipment might look like for the market they're going after. Um, but how do I know how much working capital I need? How do I figure that out to put on this loan application, if you will?
So, Mike, the more working capital, the better, but we want to have at least a few months worth of operating expenses. So it's about understanding the the finances of a business that you're acquiring, or putting together a projection if you're starting a business from scratch. So you want to look at what are you going to have for rent, what are your insurance expenses going to be, are you hiring employees? And it could be that you're starting this, as a solo
Mm-hmm.
entrepreneur. Perhaps you have a partner, right? You're going to start small and grow this. So your expenses in that instance would be less, but it's really about understanding what are these operating expenses that we're going to have to pay each month. So it's as simple as listing out what are the expenses of the business and understanding what you need to be able to provide that cushion to get started. And I think you're looking at least a few months worth of operating expenses, and perhaps more if you're starting a business from scratch, because there's some uncertainty there as to when you're going to be able to bring in customers. And we think about it, once we bring in a customer, we're going to buy materials, we're going to make a product, we're going to ship that out to the customer, we're going to send them an invoice, right? And then we're going to wait for that check to come in, or that wire transfer to pay that
Right.
invoice. So there's a period of time there that's going to elapse. It could be a couple of months, it could be a few months between the time that you receive that order to the point where you've actually been able to turn that into cash in the bank. So
Yeah,
that's
I
really
think
what we're talking about, is having the buffer to cover that period of time so that you're able to make those operating expenses.
Yeah, I think in this industry it's very common. I think a good practice at the minimum is to expect that cycle you just talked about to be a 90-day cycle from the time you get an order to the time you get paid. Right? That's really, even if they're paying net 30, you can still, you got 2, 3, 4 weeks to make it, ship it,
Mm-hmm.
invoice it. Now you're net 30 out. You might get 60 days, but you probably ought to count on 90. Right? So it brings up something I want to address here too. So again, I'm trying to figure out how much money I need. There's we've done a couple of episodes on like understanding your financial statements, and I would encourage people to go listen to those episodes. But when you're trying to figure that out, I mean, really, if you can just start with, and this is how I've always done it, I'm sure you have some insight into this, but I like to do, when I do projections, I like to do first 12 months by month, then the next 12 months or the next 12-month cycle, whether I'm doing it on a year or monthly cycle, whatever, I might go to quarterly, and then I like to have a third year, maybe it's even just an annualized number, right? And then, but I basically just take a blank P&L, profit and loss statement, with all revenue, with my cost of goods sold, with my expenses like my rent, my insurance, all those types of things you discussed, and you're gonna have a net number at the bottom, and you do that out by month, especially the first 12 months. Really, 24 is probably better, even if you're starting out fresh. Um, and you can look at that bottom number and see when you might struggle. Well, that first 3 months is going to be when you're going to struggle, because there's going to be no money coming in. Even if you sell stuff on day one, you're not going to have any money coming in for, just call it minimum 90 days. So there's not, that number at the bottom is going to be red with a minus sign in front of it for the first 3 months. I generally then tell people, okay, take that number, and what's the number at month 3? What's the lowest number on your forecast? Let's say it's minus $30,000, whatever it is, cumulative over the 3 months, and you need 60. So take that worst number and double
Yep.
it, right? It also, I think, points to, and I think this is really underutilized financial tool that maybe you and I can record an episode on separate from this. But this is where you would be well versed to learn what a 13-week cash flow statement looks like, where you're now looking at that, really that first 3 months. I mean, 13 weeks, 90 days, whatever, on a week by week basis, right? Because you got payroll to make next Friday. You've got parts to ship the following Monday that's going to get paid in 42 days. And you can really detail out that short window and really start to see what your cash needs are. I use that as a tool, especially when times are tough, but I try to keep that tool pretty well updated myself all the time. Most people have never even heard of a 13-week cash flow, but I would encourage you to learn about it, utilize it, reach out to me. I'll send you a blank one that you can start to fill out. But that to me, those are some tools you can really use to just start to drill in and say, okay, I really need $100,000 in the bank all the time, or 50,000 or 500,000. What depends on the scale of your operation, obviously. But that also makes sure you make that bank payment, and because that thing's coming due on the 3rd of every month, regardless, right? So you got to have that cash there. And until you start building up that cycle of receivables and payables that are taking care of that number, it's got to come from somewhere. And if you have, and then with those tools, I think now going to the bank and saying, this is how well I've thought this out, then that's going to increase your likelihood of getting some of that financed, in my experience.
Mike, you're speaking my love language now with budgeting and forecasting. So yeah, absolutely. The 13-week cash flow is an incredible tool. Really important for all business owners to understand what's coming in the door and what's going out the door. And that's something where you're looking at your receivables, money that you're owed, payables, money that you owe other people, and really looking at the timing of that. When's money coming in and when's it coming out? And to your point, Mike, what do we have a deficit here? At what point do we have a deficit? How large is that deficit? Um, I had the opportunity to speak with a shop owner recently who has really successful shop. He's actually acquired 6 different businesses over the course of his career, but he was talking to me specifically about that experience when he acquired his first shop. So in this instance, there was seller financing involved. There was a significant amount of seller financing, and what this owner was bringing was really his operational and management experience to that business, and that what he could add as value to that owner by improving the business. But I tell this story because what really struck me here is this owner said that that time after he had acquired the first business, that period of time between that acquisition and when he eventually got to business number 2 was the absolute leanest time for him
Mm,
in his personal finances. I
sure.
mean, Mike, he was looking back on this and, talking to his wife and just wondering, like, how did we get through that?
Right.
When he thinks about, what they had for income at that point, and being able to really continue to invest in the business and limit what he was taking out for his personal expenses. But his ability there to kind of tighten his belt and get through that stretch is what then allowed him to get to business number 2 and now have the opportunity to increase the scale of that business, to
Hmm.
eliminate some of the overhead costs and start to make that more profitable. So then he could start to draw out the type of income that, he had been accustomed to or really, really needed to support his personal expenses. But I think that, budgeting and forecasting are essential, and this could certainly be a separate
Oh, sure.
podcast. But the way I look at this is, a budget, you're outlining your plan. So we're gonna outline a plan here. I agree, 12 months. We should have a 12-month budget, that we're doing that monthly. We're outlining our plan. This is what we expect to happen here. This is what we're going to have for sales. These are our expenses. This is what the cash flow is going to be. Now, this also gets back to the question of how much working capital do we need? How much of a buffer do we need? Because we are going to have those times where we're running negative cash flow for the month, and we need to be able to cover that. Um, and then, looking kind of forward as we jump into the business, we might look at what's changed versus our initial plan, right? Because everybody's got a plan to start, right? And then
Yeah.
things almost inevitably aren't going to go
Well, yeah,
as you
what was
planned.
it? What was it? Mike Tyson said everybody's got a plan until you get punched in the face.
Yeah, so we might get
Right.
hopefully you don't get punched in the face right away, but we
But
very
it can
well
feel that
might.
way.
It can feel that way. Yeah, absolutely. So, we outlined our initial plan, which is our budget, and then it's really how do we adjust?
Yeah.
So, if we didn't have the sales that we expected, or, maybe there was some unexpected expense that hit us here in the shop. And remember, in most cases here, if we're starting off, we're looking for a shop that we can afford. We're looking to buy a diamond in the rough.
Yeah.
So there very well may be some unexpected expenses here. It could be that, there's equipment that needs to be repaired or, replaced. So how are we going to adjust as things happen? And what I'd call that is really our forecast.
Yeah.
So we've got an initial budget here, initial plan, and then how do we adjust to that based on the circumstances? And that's really going to guide the decision making that you make as an owner, and the decisions that are necessary on that business.
Yeah, and one additional thing I would encourage people to do when they're trying to figure out what that number is, and this is something I always try to do, especially, and we haven't talked a whole lot about that kind of friends, family, investor segment yet, but I think we will here in a minute. But especially if you're going out to investors, one of the things I would encourage people to do is I generally try to actually create three budgets. I have a I have my baseline budget that I really think this is what it is, and then I kind of do a worst case and best case scenario because I want to know I've got enough money to cover my worst case, right? But I also have enough money to cover my best case, right? So if because you can outgrow your capital too and go out of business, right? I mean, you can go out of business for growing too quick and not having the capital just as easily as you can not having any sales, and maybe not just as easily, but pretty darn close. And so I would encourage people to think about their budgeting process as they're thinking about their funding in kind of looking at those three scenarios. This is, for machinists, just think about it from an aspect of you've got a, you're making a part and there's a nominal dimension that you're supposed to hit. And there's a tolerance, right? It can be plus or minus 3 thousandths. So give yourself that leeway in your budget too to say, okay, this is where I want to be. If things go take twice as long and cost twice as much as I think they're going to, this is what it's going to look like. If things go really well, this is what it's going to look like. So you have those options of you have enough money to cover the worst case scenario, and you have options to cover the potential upside if things go really well right out of the gate.
I love that, Mike, and I love having the baseline and then your, kind of best case scenario, and then what happens if things go sideways. And certainly this is an area where um, you may want to call on your accountant or
Sure.
a finance professional, because there's a lot of perspective here that can be shared, and kind of knowledge on how to how to build out a budget, and how to be able to weight that for sort of your best and worst case scenarios. But 100%, Mike, it's very important here to have a plan, and to plan for unexpected circumstances and how you're going to adjust to those. And it does get back to that you need to have a buffer here in the business to be able to ride those waves as they come in.
Yeah. So let's we've talked about several different structures. The let's talk about what a mixed structure might look like, right? Because I think in a lot of cases we really start getting into no one of these is the right answer, depending on what exactly you're doing, and oftentimes, your what you might call your capital stack, your working capital, like all the money you need is coming from two, three, maybe five different sources, right? So let's talk about that. I'm buying or starting this new business, um, and what that could look like. And I'll kind of tee up what maybe some general options that people might look at. But maybe I've got a little bit of savings. I don't know if we want to pick a number, but let's say I've got access either through savings or friends and family to pick a number, $50,000. Um, so right there, based on some of the loan numbers we talked about, having anywhere from 5, 10, 20% down, that's going to start to dictate the size of business I'm looking at acquiring or starting, right? Um, I know I need some working capital and I know I need some equipment. Now, in the working capital range, so I'm going to go work on getting an SBA loan. Let's say we're targeting a $500,000 new manufacturing
Hmm.
place. That's going to be a three or four machines, couple people getting going type operation probably. Um, Probably maybe one new machine, a couple used machines, that, kind of a mix. So maybe I'm going to need, so I need a total of $500,000. Um, let's first say one of the pieces of equipment I'm going to buy is a $150,000 CNC machine, and I'm going to have some equipment financing options on that, right? Either through the machine tool dealer, or someone like a Verdant Capital, something like, some of
Hmm.
these folks that specialize in equipment financing. Then I'm going to have this chunk I need for operations and everything else that maybe I'm looking at my SBA loan. There's also some options out there. I don't know as much on startup, but definitely as you're going and growing, there are lots of grant options available that you could go through your state, and some of those sorts of things. The MEP network, the Manufacturing Extension Partnership Network. Um, so maybe I have this quote capital stack that looks like $50,000 of personal capital through some form or fashion. Um, Maybe I've got, as you mentioned earlier, maybe it's myself and someone else. We're doing this together, and maybe collectively we have $75,000 or something like that. Off of 500, so now I'm looking at needing 425. 100, let's say 150 of that I'm going to do is a new piece of equipment I'm buying that I could potentially sell or equipment finance. So where were we? 475 minus 150. So we're at what,
Man,
325 now?
yeah, Mike, you're making me do math here.
Yeah. So we're at 325 now that I need to get through the banks to finance maybe the used equipment and that first 6 months of operations, right? Till I'm up and rolling. So now I'm going to the bank asking them for 325 on what should be a $500,000 business. Well, those ratios start to make sense for the bank. Would you agree with that?
They do, yeah, and I think that, by combining multiple sources here, you can start to put the pieces of the puzzle together. Um, if we were to think about an SBA backed loan, and we're coming into this with our 50,000 or maybe 75,000 with a partner, well, the SBA might offer something like a loan with a 10% down payment.
Right.
There certainly are, there's some considerations around that. And when we think about, what the requirement is there for the down payment, it's also weighing things like your experience in the industry. So assume that, you've worked at a shop, you've got the requisite experience here, and that'll help you to get a lower down payment. So that could be one option that you explore. You could possibly piece something together here with some equipment financing, and now we have an asset. So we're looking at an asset-backed loan, which could be easier to qualify for.
Sure.
And you could even perhaps piece that together with some maybe there's some seller financing, or
Right.
maybe there's some money from friends and family that's available, or maybe you get a combination here of your down payment and some equipment financing, and maybe at that point you can qualify for a traditional bank loan.
Well, and then another piece of the puzzle that I meant to mention in there too, that should be part of your capital stack. It's going to be a little bit harder on the front end of a new company than it would be if you were acquiring. But something we've talked about quite a bit on some other episodes is part of that capital stack too could also be a line of credit, right? So you could have a working line of credit with that bank for $50,000 of that to just pull down when you need it to buy material that you're not going to get paid on those parts for 90 days.
Absolutely, yeah. And we had talked about that maybe a 90-day cycle to plan between the time we got an order to the point where we're collecting cash. So the line of credit is the tool there to bridge that gap.
Right.
So with the line of credit, the bank wants that to be secured, and that's typically in manufacturing, that's receivables and inventory.
Yeah.
And the
Yeah, and
banks,
we did a whole by the numbers episode that people can go back and find, and maybe we can point to in the show notes on establishing a line of credit and the borrowing base that would go into doing that, where you are looking at your AR and your inventory and WIP and some of those types of things. And yeah, so maybe people go back and listen to that episode too, because that can be a very very important piece of your equity stack, and as you grow, can grow with you to provide, where we were talking about even that best case scenario where maybe things ramp up real quick. Well, you're going to need that 50,000, 100,000, whatever, to buy material and pay labor to make the parts that you're going to ship and not get paid on for 60 days.
and
And that's it.
you had alluded earlier, Mike, to sometimes you can grow yourself out of business, right? And it's this exact scenario where the sales are growing, and we're taking in these new orders, we're buying those materials, but now we're sitting on receivables and we've got ourselves into a cash flow crunch.
Right.
So this line of credit would be the tool there to help you to be able to finance those receivables, and really you're financing the growth at that point.
Right.
So yeah, if we look at what this might look like to acquire our $500,000 business, it could be that we've got our down payment here, we've got a term loan, and maybe we're gonna pay that off over 10 years, and that gets us to the 500,000. But then we also have a line of credit to help
Right.
support that working capital as we get going.
Yeah. So okay. So I think we've covered a lot here. When we kind of look at, maybe what are some of those key takeaways? What are the three or four overall themes and steps people should take here in your mind, as they're looking at funding their dream here?
So I think the first takeaway is you need to assess your personal situation. You need to start with understanding your personal budget, what you can contribute to the business, but also what are your expenses? What do you need here to be able to make your mortgage payment, put food on the table? So it's starting there. I think the second step is to understand what the needs are for the business, and that's both the cost of acquiring equipment. It's also could be the cost of acquiring an existing business, and what you need for working capital.
So that budget, really
That
drill
budget,
in on that budget.
drill in on that budget. So we know our personal situation, we know what's needed here for that business, what the budget is. And then the third step is we're going to explore financing options, and there's multiple avenues here. So we've got seller financing as a potential option. We have an SBA backed loan as a potential option. We have a traditional bank loan, and that could be a term loan. We could also be looking at something like a line of credit. Another option could be equipment financing. And our takeaway here is that we want to have the flexibility to consider putting together multiple financing options to be able to both acquire the business or the equipment, and then be able to have that funding there for working capital.
Yeah, and I would say from there, with that said, this is the perfect time to really establish your network of advisors, right? So whether that's your CPA, a CFO, an interim CFO, even with someone like you. I mean, most people probably aren't looking at starting with a CFO on staff, but there's people like you out there that can help with this. Pick your bank and pick it. Don't just go to one bank and just the bank you've been banking with for 20 years may not be the right bank for your business, right? So find a good bank that understands your industry and likes to invest in this industry, because that's what they're doing. They're investing in this along with you. But have those advisors around you to help make those right decisions of how much money you need, how you should get it from that's going to affect maybe your taxes in the future, or those types of things. Um, those are that circle of advisors, I think is a step that a lot of people skip in this whole funding exercise.
Absolutely, Mike. And I would say that if you have one advisor in your network, and that could be, I don't know, it could be your CPA, tax accountant, or, it could be your banker. If you have somebody in your circle that you know and trust, that could be a good place to start to build out your team of advisors. So, I'd encourage you to talk to that professional and ask for referrals or recommendations if you are looking to build out that team of advisors. And it certainly having the right attorney and banking relationship, and then accounting and tax relationship.
Yeah. So, okay. So, listeners, we've got your mindset right. We've got your company formed. We've got your money now. Next week, you want come back and join us. We're gonna be talking about how to start outfitting your shop. Like, what should you be looking at what machines you should buy, and should you buy new and used, and do you buy for now, or do you buy for the future, or both, or some mix of that? All those types of things. So make sure to tune back in next week for that. Jon, thank you very, very much for all of this very valuable information.
Thanks so much for having me, Mike. This has been a lot of fun, and I think you promised me that for being on the show, I get to come out on the shop and touch some equipment. So
Yeah, 100%. Anytime, and you get to pet a dog while you're here, which listeners you may have heard in the background a little bit at some point, but I think most of you know I always have shop dogs around here. So, um, Jon, how do people get a hold of you if they have some follow up questions on this?
So I'm with Jon Hughes with CliftonLarsonAllen. So um, listeners could reach out to me via email. So I'm John with no H. My parents knew I wasn't smart enough to spell a four-letter word. So unlike the movie director Jon Hughes, I'm John with no H, Jon.Hughes at claconnect.com.
And if you can't find him that way, reach out to me. I'll make sure to connect you. Yeah, so tune in next time when we're going to talk about equipment, because if you don't have money, you can't get equipment, and if you don't have equipment, you can't make chips. And Jon, we always close our show: if you're not making chips, you're not making money. Bam.